The inverted yield curve, you've probably heard of it, and probably heard that it's a reliable predictor of recessions. They say it has predicted recessions in the past 50 years. They say it's infallible. Experts agree that this indicator is historically reliable. This is the inversion of the US Treasury 2-year to 10-year bond yield curve. Let's not just take it at face value, but delve a little deeper. Welcome to another episode of Money Matters. Let's backtrack a little. US Treasury bonds are essentially loans to the government in which the lender or investor will receive interest payments throughout the term and return of the full capital amount at the end of the term when the bond matures. However, instead of waiting for the bond to mature, investors can sell that bond on the secondary market. It may be that the price of the bond is above or below par, meaning that you can sell it at more or less than the price you originally paid the government, which is called the principal. Changing market conditions will dictate whether the bond you hold is attractive or not attractive, thus altering the secondary market value. So let's say you bought a 10-year government bond at $1 million directly from the government, also known as the primary market. The government is offering a 2% interest payment on this bond, meaning you will receive 2% interest every year until it matures, or $20,000 per year for 10 years. After 10 years, you will receive the $1 million investment back from the government, assuming they don't default. Let's say market conditions dictate that the price of the bond you hold falls in value. This may not be an issue since you intend to hold it to maturity. Or perhaps you still want to sell the bond at a loss as you believe market conditions will continue to become worse, and selling it early is better than holding onto it. In which case, the buyer of your bond has bought at a discount. They have bought at a price below par. Let's say they only paid $900,000 for your bond. Remember that the 2% interest is based on the original amount of $1 million. Therefore, $20,000 per annum at a cost of $900,000 is actually yielding 2.22% per annum. Furthermore, if they hold on to the bond until maturity, assuming the government doesn't default, they will receive the full $1 million return from the government. That's $100,000 profit or 11.11% return on investment. If the bond was bought with 5 years left until maturity, this means that their yield to maturity is actually 4.24% when including the gain made on maturity. Back to the inverted yield curve. There are a range of bonds to choose from with different lengths of terms until maturity. We can look at a yield curve which usually shows positive, meaning investors expect a higher yield for longer terms to maturity because of the greater uncertainty the further we look into the future. A normal yield curve implies stable economic conditions and suggests economic expansion. An inverted yield curve means that short-term rates exceed long-term rates and implies periods of economic recession where investors expect longer maturity bonds to be lower in the future. In times of economic recession, investors seek these longer dated bonds. Higher demand pushes up the price, which in turn reduces their yield. Furthermore, the nearer term rates are largely dictated by the Fed's setting of interest rates. If inflation is running high, the Fed will want to increase interest rates. In a typical scenario of high economic expansion, prices can increase too quickly, and increased interest rates will cool the economy and hinder the rate of inflation. What we're seeing right now is high inflation without the economic expansion. The Fed has already stated that it will likely increase interest rates with many more hikes penciled in for the future. But perhaps these interest rate hikes are still delayed or subdued, depending when you watch this video, as the economy is not in the phase of high expansion. Some experts have predicted a period of stagflation, meaning a stagnant economy with high inflation. Time will tell. So, as near-term interest rates are on the rise, with an expectation that economic expansion is faltering, we will see this inversion of the yield curve. And on Tuesday, 29th of March 2022, the 2 to 10 year spread of the Treasury bond yield inverted. When they say the yield curve has inverted, investors are usually referring to the 10-2 spread. They compare the difference between yield in the 10-year Treasury bond and the 2-year Treasury bond. It has predicted almost every recession in the past half century, which is why when it inverts, experts, news channels and investors' ears prick up and news spreads like wildfire. Let's take a look. This shows the spread between the 10-year and 2-year US Treasury bond yield. Therefore, when the figure is negative, this is when the yield curve inverts. It shows that the yield inverted for a brief moment and went back positive once again. It has not been a sustained period of inversion. All eyes are watching where it will go next. But before we get into a frenzy, the world is not black and white, nor should we try to simplify the financial markets. Let's put this into some context and frame it in a way so that we can better understand what is going on in the markets and what actions we can take. One of the downsides to reading the inverted yield curve is that we don't know exactly when the recession will arrive. It could be months, it could be years. Additionally, there are other measures of spread, the Fed preferring to monitor a nearer term spread like the 3 months to 2 year or 3 month to 10 year spread. And this time the inversion has not been a sustained one. It only crept into inversion for a short period of time, then recovering. If it is inverted for a longer period of time, the more chance a recession is to follow. Note that the 3 month to 10 year spread never inverted at all. Finally, and probably most important of all, there is no strong correlation between a recession and stock market performance. We can take a look here at different times of inversion. The S&P 500 index largely performed positively in most cases, and on average it was a good time to remain invested in the stock market, be it 1 month later, 3 months later, and even 12 months later, with the average returns up 11%. Why is this? Part of the reason is the largest companies on the index are so big they don't necessarily depend on the domestic economy. Think of Apple. The US market accounts for approximately 40% of its total revenue. Europe accounts for 28% and China accounts for 26% of its total revenue. Therefore, a domestic recession may not have too significant an impact on revenues of the top companies. And bear in mind the S&P 500 index is top heavy, with the top 10 constituents making up approximately 28% of the total index of 500 constituents. The smaller companies, which may be more dependent on the domestic market, only make up a portion of the index in terms of market cap. Overall, it is important not to get sucked into looking for oversimplifications of the market. See this and do this. See that and do that. The financial markets are irrational at the best of times and humiliate those who get emotional. And whilst we can use numerical and graphical indicators to help us spot probabilities in the market, behind the numbers are investors who decide where the market is heading. A stock is only worth whatever investors are willing to pay for it. Sometimes it's ridiculously low, sometimes it's ridiculously high, but eventually it will find an equilibrium, a fair price. And in the long term, markets always and eventually rise. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you like the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.